Welcome to today's Explainer. It is July 30th, 2026, and we're looking at a day that is literally going to be written into financial textbooks. The markets just experienced a massive structural shift in global asset pricing models. This wasn't just a normal trading day. This was a fundamental repricing triggered by the Federal Reserve's highly controversial decision to hold rates steady. Today we are going to unpack exactly what broke, why it broke, and how institutional capital is rapidly repositioning. Okay, let's dive right in.
So here is our roadmap. We're going to hit macro sentiment, treasury dynamics, equity market microstructure, sector rotation, a strategic action plan, and then cap it off with our final verdict.
All right, part one, macro sentiment and foundation, the Fed's strategic ambiguity.
Let's look at the headline. The FOMC just decided to hold the federal funds rate at a target range of 3.50 to 3.75%. But honestly, the rate hold isn't the real story here. The real story is the vote. We saw an incredibly unusual 9-3 split. Hammack, Kashgari, and Logan all dissented, and they were firmly advocating for a quarter-point hike. You really have to understand just how rare this is. We literally haven't seen 3 voting members fracture like this since 2016. The Fed is an institution that completely prides itself on consensus. So this 3-way split, it exposes a severe, structural, internal crisis over exactly how to handle inflation. Now, if you cross-validate the economic data the Fed was staring at, you get this fascinating contradiction. The first estimate for Q2 GDP, it came in at a pretty sluggish 1.5%. But consumer spending absolutely exploded by 3.2%. So you're probably wondering, why the weak GDP print? Well, the headline number was heavily dragged down by a massive influx of AI infrastructure imports. We're talking semiconductors, servers, all that heavy CapEx. The domestic consumer is actually still red hot. And what that means is the underlying inflationary pressures are very much alive.
And that brings us to the press conference. Fed Chair Kevin Warsh delivered a quote that absolutely defines today's structural shift. He said, "We need to observe market reaction to developments direct and unfiltered. Let that sink in. This is a monumental pivot." Warsh just effectively abandoned forward guidance. By refusing to chart a clear path, the Fed is essentially forcing the bond market to do the dirty work of financial tightening on its own. They're outsourcing the monetary policy. Moving on to Section 2, Treasury and Currency Dynamics, the Bond Market Vigilantes.
This right here is the single most critical data point of July 30th. The 30-year U.S. Treasury yield skyrocketed to 5.22%. We haven't seen this level in 19 years. We're talking all the way back to 2007. To put that into perspective, the last time yields were sitting this high, the very first iPhone had just been released. Think about that. The Fed held rates steady today, but long-term borrowing costs absolutely exploded in response.
What we are witnessing right now is a violent bear steepening of the yield curve. That means long-term rates are rising significantly faster than short-term rates. The policy-sensitive 2-year yield actually dropped down to 4.23%. But the 10-year yield surged toward 4.70%, and obviously the 30-year blasted past 5.2%. This steepening isn't random. It's the market directly punishing the Fed's inaction. Bond investors are demanding a massive premium for holding long-term debt out of sheer, unadulterated inflation fear.
And this breakdown brilliantly illustrates exactly why rates are rising. We deconstructed the spike in the 10-year yield, and a staggering 80% of this upward move is driven by the break-even inflation rate. That's essentially the market's expectation of future inflation. Only 20% is actually coming from real economic growth. This is a devastating metric for the Fed because it proves the market is pricing in a total, complete loss of central bank credibility.
To really confirm this loss of faith, we just have to turn to the currency markets. The U.S. dollar index actually dropped to 100.63 today. Now, historically, when U.S. Treasury yields soar like this, the dollar strengthens, right? Because global capital floods in to capture those high risk-free returns. Well, that correlation just broke. Yields are soaring, but the dollar is weakening. Global investors are demanding much higher compensation just to stomach the risk of holding U.S. assets.
All right, Section 3, Equity Market Microstructure Structural Dichotomy.
The equity market response to all this was just a broad, brutal collapse. The Dow Jones took the heaviest hit, plunging over 1,150 points to close at 51,594. That 2.19% decline represents the largest single-day drop we've seen since the tariff shock back in April of 2025. The S&P 500 and the Nasdaq took massive hits too. Essentially, this surge in the 30-year yield completely crushed the valuation models that equity markets were relying on.
We really have to contextualize this because it's a massive shift in market psychology.
Historically, when the Fed holds rates, stocks rally in relief, but the July 2026 reaction was completely inverted. The market interpreted this rate hold not as an act of mercy, but as a severe policy error. It heavily echoes the mistakes of 2022. The market deeply believes that by letting inflation run unanchored today, the Fed is just setting the stage for forced, rapid, and highly destructive rate hikes in 2027. That fear is exactly what triggered today's massive sell-off.
Let's pivot to Section 4, Sector Rotation and Alpha Hunting, the AI CapEx divide. So in the middle of this carnage, where is capital actually hiding? Institutional funding logic has ruthlessly evolved overnight. Look at Microsoft. They surged an astonishing 16.7% in a single day. That's adding roughly $450 billion in market cap simply because they proved their AI investments are generating real tangible revenue. Amazon surged after hours too, with their AWS cloud unit growing 37%. But contrast that with Meta, which plunged nearly 10% because they lacked immediate ROI on their heavy AI spending. The market is now exclusively, and I mean exclusively, rewarding absolute winners. And this AI frenzy, it's actually causing a massive supply and demand mismatch in the credit markets. Right now, there is a staggering $750 billion in funding demand just for AI data centers and hyperscalers this year alone. This vortex of capital is completely crowding out other borrowers and driving up the overall cost of capital across the board. We're even seeing stress within the AI space itself, like data center bonds dropping 15 points. Institutions are widening spreads and demanding incredibly strict winner selection. This brings us to Section 5. Strategic Action Plan, Portfolio Defense. Based on this absolute breakdown in central bank communication and soaring bond premiums, the immediate institutional portfolio recommendation is to increase your cash weighting to 15%. And look, this isn't just about fleeing to safety. For any fund manager watching, this is about having dry powder to absorb intense volatility. Cash gives you the opportunity to step in aggressively when valuations finally realign with this harsh new interest rate reality.
Furthermore, we need to set some strict scenario thresholds. First, watch the 10-year yield closely at that 4.70% resistance ceiling. If it breaks that, look out. Second, you have to heavily monitor external tail risks, specifically U.S.-Iran geopolitical tensions. If those conflicts escalate and push WTI crude oil past $84 a barrel, it will fatally complicate the Fed's inflation mandate by driving energy prices through the roof. It's a classic black swan threat right now. Finally, keep a very close eye on the August 6th productivity data to see if the underlying economy can actually shoulder these massive capital costs.
And finally, Section 6, Conclusion, the final verdict.
The prevailing takeaway today was perfectly summarized by DoubleLine Capital's Jeffrey Gundlach. He stated, "The bond market is signaling the Fed has to act on inflation. The bond market vigilantes have returned. The structural shift we saw today is undeniable. The central bank has lost control of the inflation narrative. Forward guidance is officially dead, and the bond market vigilantes are now aggressively and directly pricing in the true cost of capital." Which leaves us with one final, highly provocative question to ponder today. If inflation remains unanchored and doesn't return to target until 2028, how exactly will your portfolio survive a baseline 30-year yield of 5.5%? It is time to seriously reevaluate your long-term risk parity models because the rules of the game just changed. Thanks for joining me on this explainer, and I'll catch you next time.